Gold's price appears to have moved lower since our last report, following signs of easing tensions between Israel and Iran. Today we are to discuss the fundamental challenges laid ahead for the precious metal, while we'll be concluding this report with a technical analysis of gold's 4-hour chart. Following Iran's aerial assaults during the late hours of Saturday the 13th, in which Iran fired more than 300 drones and missiles, Israel retaliated last week, yet opted for the bare minimum in a move seen as an attempt to de-escalate tensions. In particular, on the morning of Friday the 19th, Israel responded by attacking a military installation on Iranian soil, but as we mentioned before, used the bare minimum in its arsenal. The limited strike, in addition to the opting of Israel to avoid Iran's capital Tehran, appears to have been widely interpreted as a show of force by Israel while allowing Iran to save face and thus preventing a tit-for-tat exchange of retaliatory strikes. Therefore, with media outlets and military theories seemingly agreeing that both sides appears to be done with this round of barrage, gold may have seen safe haven outflows, which in turn may have weighed on the precious metals price. Moreover, the theory of easing tensions appears to have been enhanced according to The Guardian, following the comments made by a senior Iranian official who stated that there were no plans for retaliation, which may have de-escalated the tensions in the region. However, the breach of the decades-long shadow war after both countries directly attacked each other's territory could set a dangerous precedent for future conflicts, which in our view increase the risk of a full-blown war between Israel and Iran rather than a proxy war. In conclusion, gold's price may be weighing down from the safe haven outflows for now. The recent financial releases stemming from the US, such as the US Philly Fed Manufacturing Index figure for April and the Atlanta Fed GDP now preliminary rate for Q1, both came in better than expected, which could provide the Fed with some leeway should they decide to keep interest rates higher for longer. In part, the financial releases imply that the US economy appears to be absorbing the impacts of the Fed's restrictive monetary policy and that keeping interest rates remaining higher for longer may not induce a recession in the US economy. Therefore, the releases appears to have allowed for an enhanced hawkish narrative from Fed policymakers. In particular, Fed Chair Powell stated last Tuesday that it will take longer than expected when referring to bringing down inflation to the bank's 2% target, and most noticeably, Chicago Fed President, who despite being widely known as Dove, stated on Friday that progress on inflation has stalled. Overall, should financial releases stemming from the US continue to provide leeway for the Fed to maintain their restrictive monetary policy, it could provide support for the dollar while potentially weighing on gold's price. The next potential hurdle could be the release of the preliminary US GDP rate for Q1 on Thursday, which is expected to decelerate the 2.4% and the Fed's favorite tool for measuring inflationary pressures in the US economy, which is the core PCE rate for March on Friday. Hence, with the core PCE rate for March anticipated to come in at 2.7%, it could dampen the Fed's intensified hawkish rhetoric should it come in as expected or lower, thus weakening the greenback while allowing the precious metal to move higher. Whereas should it come in higher than expected, implying that inflation may be entrenched in the US economy, which could amplify the hawkish rhetoric emerging from Fed's policymakers, thus aiding the greenback while weakening gold's price. Since our last report, the bears appear to have taken the reins of the direction of gold's price, with the precious metal now seemingly on a downward trajectory. We maintain a bearish outlook, and supporting our case is the RSI indicator below our chart, which currently registers a figure near 30, implying a strong bearish market sentiment in addition to the Bollinger Bands, which have widened significantly, implying high market volatility. For our bearish outlook to continue, we would require a clear break below the 2,271 support level, with the next possible target for the bears being the 2,222 support base. On the flip side, for a sideways bias, we would require the commodity to remain confined between the sideways channel defined by the 2,271 support level and the 2,325 resistance line. Lastly, for a bearish outlook, we would require a clear break above the 2,325 resistance line, with the next possible target for the bulls being the 2,378 resistance level. As this report concludes, we would like to thank you for being part of our financial updates. From all of us here at IronFX, we wish you a solid trading.